All right, for sure. Yeah, like I said, I have a few bullet points I'm gonna go over. I'm gonna keep it like I'm gonna keep it simple but effective because there's like I don't know, there's like sometimes like when I'm talking to like newer traders or just people who need help, like when I explain like certain things to them, such as like time frame correlation and just things about candlesticks, like even though it's simple stuff, like the way like I can explain it and the way like they understand it, like it really like clicks for them. Because a lot of the times like you're like the simpler, obviously the simpler the better. And when you get that like clicking moment, even if it's not like even if it's little clicking moments here and there, they can all add up to like your full understanding of the market. So it's really cool what I'm going to go over. Just like and obviously GA is a perfect example. So I'm obviously going to pull that up. He was acting crazy earlier. We'll give it like one more minute. What's up, everybody? I'm Mason, by the way. If I haven't met y'all yet, Mitch asked me to feature on one of the calls, so I told him I would. Let's see. Yeah, if y'all have any questions, either if y'all want to ask them, just wait till the end, or you can just type it in the chat and I'll respond back to that. Um, so how long has everyone been trading in here? You said in the chat. 2.5. Yeah, I've been trading for about like 2.5 years, coming on to 3. I found out about trading like a little over 2.5 years ago, but I didn't really get the right education. So I kind of spent all of 2016 not really as effective as I wish I would have, but you know, it happens. You just got to find the right mentors, the right people to learn from. Got to find the right style, everything like that. So, you know, it's life, but as long as you learn at some point, I mean, we're still young. We got all the time in the world. That's why I feel like a lot of people struggle with, you know, like a lot of people just like want that satisfaction instantly or want it faster than usual, you know, and like that's what messes people up a lot, just like strictly on the charts. Like most traders problems, most new traders, their problems are like blowing their account. Like you always hear like, oh, I blew my account. Like you would never blow your account if you risked properly and had the right trading plan at hand, you know. And I think the main reason a lot of newer traders like over leverage their account is because they want that big money, they want that big like trade, you know. And it's a lot easier to see like an $1,000 trade rather than see like multiple trades add up to $1,000 over time, you know. Everyone just wants to see that one big trade, but it honestly like that's what kills a lot of new traders is just wanting it fast. Like your account grows faster than you think. A lot of people don't have the patience. So trust me, like the person who focuses on the risk management and compounds their account versus flipping it, their account's going to be a lot bigger over the span of a few months or over the span of a certain number of trades. But yeah, I'm going to go ahead and share my screen and get into it. Let me move this. Yeah. So basically the main thing I'm going to go over is just the main topic is basically like keeping it simple. And I know that sounds simple to say, but really it's a lot simpler than you think. Like if you think about it, I don't know if you've been taught this before or told this analogy, but I always like to think of the markets like a clock, like time. So there you have days, you have hours, you have minutes, you have seconds, you know, but you can't have a minute without 60 seconds and you can't have 60 seconds without 1 second, you know. Seconds build up to minutes, minutes build up to hours, hours build up to days and so on, you know. So that's how you have to think of the market. And I'm not showing y'all a strategy. I'm not giving y'all any methods. This is just how the market is. In its simplest form, just think about it. These candlesticks represent certain time frames, right? And the reason I start on the biggest time frame, when I look at a chart, it's called top-down analysis. I start on either the monthly chart or the weekly chart and work my way down all the way to an entry time frame. So the reason I start on the bigger time frames is because the support and resistance and the levels on the bigger time frames are obviously going to be the strongest. Like a resistance on the weekly time frame is going to be a lot stronger than a resistance on the 1 minute time frame. So
and the levels on the bigger time frames are usually going to be the strongest, all the way to an entry time frame. So
don't mind muting your mics just so it doesn't echo. Sorry, I get really distracted pretty easily. If everyone could just mute their mics, I appreciate it. Thank you. But yeah, like I was saying, so just think about it. Each of these candlesticks equal a certain time frame. So in this case, the weekly time frame, each one of these candlesticks is equivalent to a week. So what I do when I'm looking at a chart, when I start on the biggest time frame, like the weekly, this is the pound Aussie. So the Great Britain pound to the Australian dollar. This is pretty much the only pair I trade. I've been looking at this pair for almost a year now, strictly this pair. And it's just, I know it, I get to know it. That's another important thing. Like once you find that pair, or even if it's not your favorite pair, like over time, like sticking to like 1 to 2 pairs really helps out because you're already going to know what time frames to start on when you're doing your analysis. But getting back to it, so yeah, when I look at the pound Aussie, I'm going to start on the weekly time frame. There's no need to go on the monthly time frame because to me it's too condensed and I want more detail. So I have my support and resistance lines drawn out on this weekly time frame, and obviously you can see how they respect the support and resistance over time. But what I want to get into is like how I look at it each time frame and what each time frame means. So when I'm starting on this weekly chart, I'm not looking for any structure. I'm not looking for any uptrends or downtrends. I'm mainly just looking at the support and resistance, and I'm looking at the momentum. So obviously you see right now it's at a big resistance level. I have this weekly resistance line drawn out, and you can also see if you look left, it's at a resistance as well. Next, I'm looking at the momentum. So judging by these candlesticks, you're seeing that there's big bullish candles forming. My bullish candles are blue and my bearish are white, if you haven't noticed already. So what's up? Sorry, never mind. Yeah, so when I'm on this big time frame, like I said, I'm not looking at any trends or market structure. I'm looking at the momentum. So if you look at these last 2 candlesticks that have formed, they've both been bullish candles and they've both had a lot of volume to them. Volume meaning the body of the candle is significant compared to the wick. Like if you look at this candle right here, it's almost all body and little wicks on the ends. And also if you look at the moving averages, I'm not sure how many of y'all use moving averages. It's probably the only indicator I use, and I only use it for momentum. So basically it's saying based on the previous certain amount of candles, what the momentum is. So red over blue means bullish, or blue over red means bullish, and red over blue means bearish. So after noticing how these last 2 candles were forming and how bullish they were, you can also look at the moving averages and how the blue and the red are separating further and further apart, which is showing bullish momentum. So knowing that, I know that overall the market is in a bullish market. So what does that mean for the smaller time frames? If you're on a big time frame such as the weekly chart and all the momentum is going up, what kind of trend would you expect on a smaller time frame? If all the momentum is going up on a big time frame, you're likely to see uptrends on a smaller time frame. It just makes sense because one of these candles is an entire week's worth of price. So let's just do this for example. Let's just highlight the last 4 candles. So I'll start with this one. We'll highlight this one, this one, this one, and this one. We'll go all the way down to the wick. So we have this bullish candle, a bearish candle, and then 2 bullish candles. So let's just highlight those. This is on the weekly chart. So we see these last 4 candles. We've seen 3 bullish candles and 1 bearish candle. And then you also see the moving averages separating further apart. So like I said before, all the momentum is going up. So the reason I highlighted this is because this is basically 4 weeks of price movement. So 1 whole month. And the price has gone up on the weekly. So what kind of trend would you expect to see on the smaller time frames? Like I said, an uptrend. I know this chart very well. So I know that my next step is to go down to the 4-hour. Yes, I do use the daily chart on this time frame, but my main market structure, which means my uptrends and downtrends that I look for, mainly I use the 4-hour chart. So let's see what all these bullish candles and momentum looks like on the 4-hour chart. with this highlighted area. And here it is. So basically, on the weekly chart, all of these bullish candles, just candlesticks on the 4-hour chart equal uptrends, right? Because these were all bullish candles on the weekly chart, but when you break it down on the 4-hour, you're seeing uptrends, right? Because bullish momentum means on the smaller time frames, you're going to be seeing higher highs and higher lows being formed. So an uptrend consists of higher highs and higher lows, and resistance continuously being broken. So these red lines signify resistance being broken, and I also highlighted them in orange. So this high was broken, making a higher high, retracement. This high was broken, making a new higher high, and now we have another retracement. So now I've established that. So A, on the weekly chart, I've established bullish momentum, and then B, on the 4-hour chart, I've confirmed that bullish momentum by looking at the uptrend, and now I'm seeing an uptrend. So what's my next step? Well, my next step is if I'm in an uptrend, I'm looking for buys. And if I'm looking for buys, I only buy at low points, because I'm sure you've heard the term buy low and sell high. So obviously, when you're in an uptrend, you're in a buyer's market, and you don't buy high, you buy low. So our next step is, okay, we see these lows being formed right here. When is the next low going to be formed so I can enter a new buy opportunity? So my next step is, okay, we see it retracing right here. When is this retracement going to stop to give me another buying opportunity to take advantage of this bullish market? Well, it's pretty much the same concept. So if you're seeing an uptrend and retracement, a push and retracement on the 4-hour chart, you're obviously going to want to break it down to a smaller time frame to see more detail, because there's no way of knowing when this retracement is going to end on this time frame. It could go all the way down to here. As long as it doesn't break this low right here, then you're still in a valid uptrend. As long as a low isn't broken on an uptrend, it's still valid. So say you just guessed and gotten a buy right here, and then it goes all the way down to here. Like on GA, on this pair, that's a lot of pips. That's going to be over 300 pips just on the 4-hour chart. So you don't want to do that. You want to get the best entry with minimum drawdown and maximum profits. So what's the next step? Well, let's take this example again. So on the weekly chart, a bullish candle on the weekly chart would be an uptrend on the 4-hour chart, right? Because it's a whole week of bullish movement on the 4-hour that's going to be forming uptrends. So how are we going to know when this is going to end? So let's take it like this. So hours equal days and days equal weeks. But what equals hours? Minutes, right? So the next step is to see on the smaller time frames how this is forming as the retracement. Because at its simplest form, an uptrend on the bigger time frame. Here, I'll draw an example. Let's see. So say this is like, we'll keep it simple. So say this is, we'll just take this example. Say this is the 4-hour chart right here, and you're in an uptrend. Oops. Oh my goodness. Cool. All right, so say you're in an uptrend on the 4-hour chart. You have a push and a pullback, a push and a pullback. If you broke that down to, say, the 30-minute chart, so basically eight 30-minute candles equals one 4-hour candle, it's not going to look like an uptrend, right? Every push and every retracement basically is going to be an uptrend transitioning to a downtrend, transitioning to an uptrend. Because just think about it. We're on the 4-hour chart right now. Every single one of these candles is 8 30-minute candles. So it's going to be a lot more detail. So in theory, if you're looking at a time frame, say you broke this down to the 30-minute chart, this uptrend is actually going to look like this. So your pushes are going to be your 30-minute uptrends. And then once you have your retracements, basically your pullbacks on the 30-minute, that's going to be your breaks of structure. It's like a trend within a trend within a trend. That's what I tell people the market is. Oops. And then once your retracement ends, you have another push. Whereas on the 30-minute, that would be your downtrend transitioning to your uptrend. So boom, there's your break of your high, and now you're pushing up. So it's the same movement, it's just in more detail. Where on the 4-hour, you have a push, a pullback, and a push. On the 30-minute, you have an uptrend transitioning to a downtrend, transitioning to an uptrend. So that's what I really want to instill in y'all. It's not a strategy. It's not like any type of method. It's just how the market works. All the market is a trend within a trend within a trend. Daily candles make up weekly candles. 4-hour candles make up daily candles, and so on and so on. It's just that we have to break this down to an entry time frame to where we get the lowest amount of drawdown and the most amount of profit, so we can get those pinpoint entries. So does that make sense to everybody? This analogy, the 4-hour and the 30-minute? If I could just get like one yes, then I'll know I explained it well.
Yes.
Awesome. Yeah, I never want to go too fast, because I know it's a lot, but hell yeah. Thank you, Max. Let me delete this really quick, and then I'll show you all the example. An example that's happening in real time. Oh, I can just do this. Object tree. So now we're at current price right now on Great Britain pound, Australian dollar. And now we're going to the next step. So this is a perfect example. So like I just drew out, we're on the 4-hour chart. We have a push and a pullback, a push, and now we're waiting on this pullback right here. We're waiting on this pullback. So if I were to break this down to the 30-minute chart, what would we see? An uptrend transitioning to a downtrend, transitioning to an uptrend, and now transitioning to a downtrend. So if we broke that down to the 30-minute chart, and I already drew it out for y'all. So basically, this big push on the 4-hour chart, boom, this whole push up right here on the 4-hour, this is what it looks like on the 30-minute. It's an uptrend. All we're doing is breaking that down into more detail. So what's our next step? How are we going to know? What did I say on this pushes? How do we know when this push is going to end and this retracement is going to start? Well, on the 30-minute chart, it's going to be an uptrend. And we know when the retracement start is when the uptrend breaks structure and it transitions to a downtrend. So on the 30-minute chart, that's exactly what we see. So you have your high point. I'll mark it off. And then you have your higher low point right here. All right. And now you have your push to your high point up here. And then you have your low point, higher low. And I'll explain why I chose these points in a little bit. I just want to show you all the break. So you have this is the push up on the 4-hour. You have your high point, your pullback, your low point. Your high point, your pullback, your low point. Your high point, and then your push. So if you drew a line, making sure the low isn't broken, you actually see that it was just currently broken right here. So there's your break of structure based on this 30-minute time frame. So you can see that the market made a new high point. It pushed down, made a solid support point. It tried to push up one more time. It couldn't break this high point. It actually met pretty much even with it right here. And then pushed down one more time. It couldn't break this low point. It tried to push up one more time, and then boom, you see it finally break that support. So you see it break that low point right there. So what does that tell you? That this break of structure on this smaller time frame is just the reversal on the bigger time frame right here. So how do we know when this push is going to end? We look at the smaller time frame, and the push is really an uptrend transitioning to a downtrend, which is the retracement. So that's what we see on this 30-minute time frame. You have your high, your low, your high, your low, your high, and then your break. Boom, right there. So what's the next step? Well, there's two options. Either A, if you want to be really safe, you can just wait for this retracement to end and then get in your buy and just take advantage of that trend. Or B, you can catch the retracement, which is the sell, and then once it stops, catch the buy as well. It's really up to your trading style, because at the end of the day, it depends on the pair and it depends on the time frame. But just knowing this 4-hour chart, even a small retracement, like just to previous, let's just say a retracement to this previous high right here. Let me delete this. A retracement to this previous high. Let's say the market went right to this previous high before it went up. That's still, from current price, that's still almost 200 pips. So some traders would be like, oh, I don't want to miss out on those 200 pips. I want to take advantage. And more conservative traders might be like, okay, well, I'm just going to wait this one out. I know it's a bullish market and I'm only going to buy in a bullish market. It really just depends on what you're comfortable with and how patient you are as a person and as a trader. So in my opinion, it really depends on how comfortable you are with this market. 200 pips is a great opportunity to catch, and especially if you're seeing the market clearly. So even though it might be a counter trend, some people would say like a counter trend trade on the 4-hour time frame, in reality, if you just take into account that, yes, I know I'm in an uptrend and I know this is just a retracement that might end soon. If you just keep that in mind, then you won't get lost in the smaller time frames. Just recognize that, yes, even though you can take advantage of this downtrend on the smaller time frames, just recognize that you're still in an uptrend on the 4-hour chart. So there's still a lot of bearish momentum. So just be careful with taking advantage of this retracement. But as you can see, if you go on the smaller time frames, this is exactly what you're seeing. Let's see. You're seeing your initial break, your initial high, and then you could just be seeing, stuff like that. Because whereas this is a downtrend on this 30-minute chart, on the 4-hour chart, that's just going to be your big retracement. So I just wanted to go over something simple like that, just because a lot of the times, like, you get taught all different kinds of strategies, all different kinds of like indicators, this and that. Whatever your trading style is, at the end of the day, you still need to understand candlesticks and time frame analysis, because no matter what style you have, no matter what indicators or whatever you use, candlesticks are candlesticks. All candlesticks are data, and you have to understand what kind of data it's presenting to you. I mean, if you draw, I don't know how many of you use Fibonacci. This is basically just like a tool to help you gauge where you are on the retracement. Right now we're at that 38.2. I mean, this is a valid level for it to actually push up, I mean, this market could just stop here and reverse, or it could go all the way to the 100 and then reverse. So it's the only way when it's going to actually reverse and you can continue your trend is by looking at those smaller time frames, because that's going to give you the clues before it happens. Like, you could guess and take a buy right here and then say it shoots down all the way to here. Like, that's a big loss, and I don't think a lot of people would want to take that. So just showing y'all how to break it down in the most simple form, it will really teach you a lot of patience and a lot of maturity in your trading, because most people, I'm sure most of y'all can easily see that, okay, well, this is a beautiful uptrend. We have higher highs and higher lows, higher highs and higher lows. You can obviously spot a beautiful uptrend with your eye, but it's when you get down to the entries and when you get down to the drawdown and everything like that, that shows like how mature you are and how patient you are in the markets. So it's just about breaking it down time frame by time frame and seeing which time frame suits me best, So typically my steps are, I basically break down charts in 4 steps. So step number 1 is like the big picture time frame, which which can be used for like your overall momentum slash candles or support and resistance. Like, so in this case, this was the weekly time frame. I'll just put that in parentheses. And then step number 2 is your main analysis time frame. And basically that's used for your market structure slash trends. And this is what I'm using right now, which is the 4-hour chart, for example. And then next step is your counter trend time frame slash pullback time frame. And that's used for, like we said, basically your retracements slash reversals. And that's what I was using the 30-minute chart for right there. So those are the first 3 steps. So just going back over it, step number 1, that's not going to show on that time frame. Where is it? Yeah. So yeah, so step number 1 was when I went on the weekly time frame. And basically when you go, and remember, it's going to vary. You know, it's not always going to be the weekly time frame. It depends on what pair you trade. You know, it could be you could start on the monthly, or you could start on the daily. You know, usually it's the daily, weekly, or monthly you're going to start off on. And that's just to see the big picture. You know, you always want to see the big picture before diving into the smaller time frames. You're going to use that for your support and resistance and your overall momentum, like I did on the weekly chart. I'm not looking at any uptrends or downtrends because it's such a big time frame. I'm looking at if it's at a major support and resistance level and how the candlesticks are forming. Because like I said, if you're on the weekly chart and you see a big bullish candle, more chances than none, it's going to be an uptrend on the smaller time frame. So it's really important to see how the momentum is going on the bigger time frames. And then once you establish what the momentum is, in this case it was bullish, then you go to step number 2, which is your main analysis time frame. And if it's a bullish momentum market, you're going to see your market structure, which will be an uptrend. You're going to see higher highs and higher lows, and that's how you're going to establish what entries you're going to get in. So in this case, it was a 4-hour chart. Like I said, it's going to vary depending on what pair you're on. So you see the big picture, you establish the momentum. Once you establish your momentum, you go on your main analysis time frame and you establish the trend. Once you establish the trend, then you can go on your smaller time frames and look at the counter trends and the pullbacks for your retracements. So in this case, this was a 30-minute chart. So on the 30-minute chart, my uptrends, my pushes and pullbacks on this time frame, you have uptrends. Let me shorten this. You have your uptrends transitioning to your downtrends. So that's basically step number 3. And then step number 4, that's going to be your entry time frame. Entry time frame. And this might vary because it's a case-to-case basis. For me, M15 to M5. Now, a lot of the times, it depends on the pair you trade. Step number 3 and step number 4 can be the same time frame, you know. I know with like pairs like Australian dollar and New Zealand dollar and stuff, and pairs like that, you can easily enter on the 30-minute chart, sometimes even the hour chart, you know. You can enter on pairs like that. But with pairs like Great Britain pound, Australian dollar, that's still like entering on the 30-minute chart is still taking a big risk, because a simple push, even on the 30-minute chart, a simple push, let's just take this one candle, just one candle. This one 30-minute candle on Great Britain pound, Australian dollar was from wick to wick, 70 pips. Like when candles are still moving that amount, 50, 60, 70 pips in one candle, you really want to go to a smaller time frame for your entries. So I would be entering on like the 15-minute or the 5-minute chart for this pair, just because I know the pair very well. So reiterating everything one more time, and then I'll answer questions. Step number 1, go on your big picture time frame, whether it be the weekly, the monthly. Look at your support and resistance. See if price is at a major support and resistance level, and establish the momentum. Once you've established the momentum, go on your main analysis time frame and establish the trend, uptrend or downtrend, lower lows and lower highs, or higher highs and higher lows. Once you establish that, then you can look at the counter trends and look at the retracements. And then once you find when a retracement ends and it's time for it to reverse, then you can go in your entry time frame and place either your buy or your sell. But yeah, just keeping it simple like that. I mean, honestly, you can get into like how candlesticks form and how wicks form and what's a proper retracement, what's a proper Fibonacci retracement. That's for a whole nother webinar, and I'd be on here for like 3 hours. I can literally teach forever. I just wanted to instill into y'all the simplicity of candlesticks, and they're not as scary as people think. Like, just remember, like, a candlestick on a bigger time frame is just going to be a trend on a smaller time frame. You know, like all these bullish candlesticks right here were just bullish trends, which is an uptrend on smaller time frames, higher highs and higher lows. And that goes the same all the way down your entry time frame. That's 61.8 on them. Oh, what up, Trey? I didn't know you're on here. Yeah, but this like I said, it's gonna vary on all the pairs you're on, just by how many pips they move in a day, what the range is on all of them and stuff like that. But I just wanted to, I explained this to one of my friends the other day when we were studying, and she was like, damn, like that made it a lot more simple for me. And I was like, yeah, like just simplify it as much as you can, you know. Entries can get confusing, like this and that. A lot of stuff can get confusing, but if you just know, like, just simplify how candlesticks are and how they form, and you'll really understand how the markets move on every single time frame. So yeah, that's pretty much all I have. What up, KJ?
Yo, we appreciate you, Mason. Thanks so much for hopping on tonight. And I know you had a tight little schedule tonight, so I appreciate you making some time for us.
Yeah, for sure. Sorry if I sound a little stuffed up. It's a little cold out here.